When we think about capital market assumptions, one of the main takeaways is that climate change, that's both physical and transition risks, worsen the growth inflation mix. So you get a bit less growth and a bit more inflation. And absent further action, reduces risk-adjusted return, so lowers that efficient frontier.
Welcome to Well Said, discussions with Wellington Management investment and research professionals about market, macro, and geopolitical dynamics affecting investor outcomes now and into the future. I'm your host, Thomas Mucha, Wellington's geopolitical strategist and member of the firm's global macro team. Long-term investment planning requires the integration of capital market assumptions. Without these CMAs, asset allocators would have nothing on which to base strategic plans. Now, CMAs can and do change, given secular dynamics like deglobalization, new macro regimes, geopolitical shifts, of course, and climate change. Today, we're discussing just that, the effects of climate change on capital markets. In short, why asset allocators should be paying attention and what they can do to prepare for an investment future shaped by climate change. My guest today has been spearheading research on this topic. She's Wellington's head of multi-asset strategy EMEA, Supriya Menon. Supriya, thanks for joining me and welcome to Well Said.
Thanks for having me, Thomas. It's wonderful to be here.
So before we get into today's topic, which is, of course, critical to the future of markets, to say nothing of the planet, I'm curious about your professional background, Supriya. So what's been your career path to now leading the multi-asset team for Wellington's Europe, Middle East, and Africa team?
Thanks for that question. So I started my career at the tail end of the dot-com boom, so in 1999, in Morgan Stanley in New York. So in terms of my career path, I've always been someone who likes looking at the world from the top-down perspective. And since we're focusing here on climate, you might say looking at the wood rather than the trees. I spent time analyzing emerging markets as an equity strategist for a while, as a hedge fund analyst. And since about 2009, I've been working in various roles within multi-asset strategy and portfolio management. So I've always had an interest in thinking about long-term strategic themes, even ones not directly front and center for markets right away, and doing the work on how they might influence how we invest and allocate over the long term. So I started working on sustainability themes within a multi-asset context about 5 or 6 years ago and joined Wellington in early 2022. I've also lived and worked in many countries, grew up in India, but since then I've lived in the US, Switzerland, and in the UK. I call London home.
Excellent. So a wide background, putting all of those skills to use, no doubt. But very quickly, Supriya, remind our listeners what the remit of the investment strategy team is.
So investment strategy, which we call iStrat, is a strategy and solutions platform within Wellington. We like to say that most investors at Wellington really have to focus on one thing, which is managing their portfolios to exceed client objectives. But we have the privilege of doing three things. So as a head of multi-asset strategy for EMEA, I build customized solutions for clients. I help manage products and solutions and also use research-driven insights. And I work on the research myself together with others in the team to help clients address their investment challenges, of which climate is one among many. So an important thing to remember about the research that we do within iStrat, and it's a critical part of how we deliver our solutions, is that we deliver that research from an allocator's perspective. And it really comes from managing portfolios ourselves. And it helps us engage in these discussions with our clients as peer allocators. So examples of the research, it's really quite wide-ranging and how we think about market regimes to how you generate income in a diversified multi-asset framework or how to approach currency hedging. I always like to say to clients, if you have a thorny problem you're grappling with, it's quite likely we've done the research on it.
Okay, well, speaking of thorny problems, let's unpack the work your team has done to help asset owners who want to incorporate climate considerations into their strategic asset allocation plan. So first, what was the genesis of this effort? Why did you undertake this project?
The starting point is really our belief, and it's really an investment belief, that climate change affects investment outcomes. And that really underpinned our decision a couple of years ago to integrate climate into our asset allocation process. The other thing I'd say is that Wellington has deep client relationships with a range of asset owners across channels, and clients see their long-term portfolios challenged by climate change. They know that things are getting worse, but they often struggle with this question of, well, how do you make your portfolios more resilient, whether that implies taking a risk-based perspective or indeed taking advantage of opportunities in the transition, as well as an adaptation. And at the same time, we have the opportunity at Wellington to gain insights through our partnerships with some leading organizations in the scientific area. So that's Woodwell Climate Research Center and the MIT Joint Program on the Science and Policy of Global Change, as well as our team of climate experts internally who make this connection between the science and the investment materiality. So we're quite a unique spot to partner with our clients on this.
Yes, in particular, the Woodwell Climate Research Center, which you just referenced there, is an important part of my research process as well. I get to take the analysis and the expertise of these great climate scientists and incorporate it into my own research. So that works across firms, it works across teams, it works across individuals. I know this can get complex quickly, but let's give an overview here of the framework and the pillars that this most recent research is built on.
So you mentioned the word pillars, and we do think of our work as sort of being a framework that's constructed on 3 pillars. So the first one is really the top-down one. It's focused on incorporating climate-related inputs, including transition and physical risks, into our 10-year capital market assumptions, our CMAs, that really underpin and anchor our strategic asset allocation. Now, we take a scenario-based approach that range between sort of slower and faster paces of transition. And we do this because we know that the future is going to be a little bit different from the past in this respect. And the pace of transition is difficult to anticipate. So scenarios give us a bit of a framework for doing so. And it's important also to know that these underpin this SA, strategic asset allocation, for all of our multi-asset portfolios. So we don't have climate-aware and non-climate-aware SAs. We just have one set of climate-aware capital market assumptions. Now, the second pillar, which we worked on last year, is our effort to add relevant climate metrics to an asset allocation optimization process that we use to construct portfolios. So in doing so, once you integrate those objectives, what are the trade-offs you have to face in portfolio construction? And we also then decided to extend the research into a third pillar, which focuses on the bottom-up piece of this, implementation, and the choice of specific climate-aware building blocks and strategies to express a desired asset allocation. For example, how do you think about passive versus active strategies, growth versus value orientation, and other aspects of portfolio construction? Now, these 3 pillars help give us the sense of a kind of total portfolio approach to integrating climate into multi-asset portfolios. The goal of this was to come up with a blueprint. So it's a 7-step blueprint that we hope can serve as a guide to our clients, either its individual components or as a whole.
Supriya, you mentioned MIT, you mentioned the Woodwell Climate Research Center. Who are some of the internal partners that helped collaborate on this project?
Yes, so we have a really collaborative culture at Wellington, and this research has really been a testament to that. So we leaned into not just those external folks that I mentioned, but also internally, our climate team helped us with the research in many ways. We conducted 20 or 25 interviews with investors and experts across the firm, really to integrate their insights on how they invest with climate change as a key parameter. And here, it really enabled us to come to this rich understanding of the diversity of approaches we have at Wellington, which then allowed us to do this research on portfolio construction, incorporating these strategies.
Okay, so what has the research revealed? And to you, what are some of the key findings?
So when we think about capital market assumptions, one of the main takeaways is that climate change, that's both physical and transition risks, worsen the growth inflation mix. So you get a bit less growth and a bit more inflation. And absent further action, reduces risk-adjusted return, so lowers that efficient frontier. This is because you have to think about higher carbon prices as a tax. So the more you undertake mitigation, the higher the price of doing so in the short run. But over the long term, you do develop technologies that enable those costs to come down with increased scale. So you can think of the cost going up over a shorter period and coming down over a longer periods in those sort of higher mitigation scenarios.
What's that time frame for that trade-off?
Yeah, so if you think about the next 10, 20 years in the orderly net zero scenario, so that's the most orderly and upfront of the mitigation scenarios that we've incorporated, that's when it ends up being the most costly. And those costs come down with scale over the long term. This varies between technologies, of course. But if we think about physical climate risk, there is an impact that is longer term, and it worsens the further out you go if you don't take stringent actions on mitigation. And that's because acute events become more frequent, more impactful. This adds to pressure on supply chains. And chronic physical risk can also depress productivity, so that increases inflation, reduces growth.
So we have a more inflationary world. We've got lower growth. We have a wider set of potential outcomes in terms of climate outcomes and climate impacts. What else?
Yeah, so there are ways to improve upon this. You can reduce your risks and expose yourself to the opportunities in this transition, as well as in adaptation. So I spoke about Pillar 2, and one of the ways you can do this is to optimize your portfolios using climate metrics. Of course, in getting to a portfolio that is more climate aware, more resilient, there are also significant trade-offs in the form of high turnover, high tracking risk in your portfolio, for example. So a preferred approach is really what we explore in Pillar 3, which is focused on implementation. How do you undertake more thoughtful portfolio construction? How do you think about active management helping you solve some of your trade-offs and getting you to a better place? And we really believe that this implementation piece plays the most significant role in building a climate-aware multi-asset portfolio.
Well, what are some of the considerations clients should be thinking about as they implement this framework?
This really goes to the heart of the 7-step blueprint I mentioned earlier, and we really recommend that clients take a look at it if you have the chance. I won't go through all of it, but a couple of considerations I'd like to highlight. The beta piece is important on the climate-aware CMAs. And as I mentioned, it does change your inflation and growth assumptions. But ultimately, it represents a more realistic baseline from which you can take actions to reduce some of that negative drag. Another piece that we explore and that we recommend that clients do is to incorporate physical climate risks at the top down and also ideally at the single security level. We also take a view that adaptation is complementary to mitigation, offers a rich opportunity set for solutions. So most asset owners are multi-asset allocators first and foremost. And while they are keen to make sure that portfolios integrate sustainability as a critical way to achieve resilience, they also need to balance that against other risks coming from, say, style factors or sectors. And while there's likely to be some trade-off between meeting climate targets and achieving diversification, the work that we do suggests that an active, diversified set of approaches are better suited ultimately to the pursuit of those climate objectives, while also allowing for a reduction in portfolio biases. We suggest that clients lean into heterogeneity in their portfolios. The other point I'd make is that sectors are a bit more complicated. When you integrate climate, you do end up with a portfolio that ends up being tilted towards specific sectors. But also traditional sector or industry classifications may not be as useful when framing the climate opportunity set. Also, some sectors thought of as problem sectors, so part of the problem here, so thinking about materials or utilities, are also part of the solution. So that's another area where we have to be quite thoughtful in constructing the right type of exposure.
Well, congrats on getting it to 7 steps. It sounds like there should be 17 or 18 steps here. You did mention adaptation. And, from my perspective as the geopolitical strategist at Wellington, obviously there's a direct connection here with the national security environment, the geopolitical environment. The policymakers that I speak to, do view climate change through this national security lens. It's further stressing an already complex geopolitical environment, particularly in the equator and tropical regions where many of the geopolitical hotspots sit. So they view adaptation as the best insurance policy, for warding off many national security problems that are coming as a result of climate change, from climate migration to more resource wars to food and water, scarcity issues, and on and on. So I'm wondering, Supriya, as governments increasingly work to build resilience to physical climate change risks, and of course, at the same time try to transition to a low-carbon economy, how do you see capital market assumptions evolving over time, particularly in this very challenging geopolitical backdrop?
Yeah, so you brought up the geopolitical piece, and this is an important consideration in how we think about a scenario. So let me just touch on the transition scenarios, and I'll get to physical risk. Our scenarios are now more disorderly and delayed. So these reflect the impact of policy delays in some countries, a lack of coordination, or certain actions which can make things worse, at least on the affordability front. So I'm thinking, for example, just one example, tariffs on Chinese electric vehicles. So because these increase costs, they can potentially delay the transition by introducing more resistance to it from the point of view of consumers. So governments do act and are acting on the transition, but those scenarios, which you can think of as too little, too late, and too disorderly, end up being more probable. So that is something we consider in terms of the probabilities we place on these scenarios and how we think about scenarios individually. The other point I'd make, and I completely agree that physical risk and building adaptation strategies are really important, especially for emerging markets, and more governments are including it in their sort of policy mix. But the other point I'd like to make is that the slower the transition, the more onerous the adaptation to physical climate change can be. So the relationship between the two isn't linear, but exponential. So once you get a transition that's incredibly slow and incredibly disorderly, your adaptation costs also increase significantly in an exponential fashion. And all of that really feeds back through to the politics of it. And we are in a situation where the direction of travel is a little bit more disorderly.
Yeah, I would say that geopolitical conflict and geopolitical competition is a negative in a lot of ways for decarbonization, because these are such strategic industries. You mentioned EVs that governments are trying to protect. There's also increasing competition for critical minerals that are necessary for decarbonization. And all of this is wrapped up into this great power competition with U.S., China, and their allies on each side. And so the geopolitics is running squarely through the adaptation versus mitigation debate. And it's a tough time to be a policymaker and to try to balance all of these different variables.
Absolutely, it is. And from the point of view of an asset allocator, things like commodities are important because they are critical to how you build inflation-resilient portfolios. So we have to get back to this point on how do you balance your more traditional portfolio objectives. For example, wanting to have some inflation sensitivity built into your portfolio to make yourself more resilient from that perspective, and how that works with also making sure you integrate climate. So really thinking about critical minerals and commodity supply chains and which commodities you want to be exposed to, and being quite active in terms of the mix of commodities you might have is one example of approaches that have resonated with some of the clients we speak to. And it goes also to this point of clients wanting to consider how to integrate climate across asset classes. So while the initial work was done within equities and then to corporate bonds, we're now speaking to clients more about, well, how does it work across asset classes? Things like the carbon intensity of commodities, or how you evaluate climate risk in sovereigns. Do you place different weights on different factors in emerging market sovereigns and developed market sovereigns? So these are questions and points of engagement we have quite frequently.
Well, that's a complex backdrop among asset owners. So among those who are interested in incorporating climate change into their assumptions, I imagine that some are more concerned about financial risks. Others might be more excited about the involving investment opportunities. that are clearly here. So from your perspective, Supriya, what's been the overall reception to this research? And what aspects of this have clients been most engaged with so far?
That's a great question. And I'd say that the general feedback has been very positive across channels. And the three pieces I referred to, the three pillars in a way, have been among the most highly read and engaged with among the research that we produce. And we've engaged with institutions all the way from very large sovereign wealth funds to pension funds, wealth managers, insurers, among others. And on the one hand, you have these really large institutions who consider themselves sort of universal owners. So they're focused on the beta side of things, the financial returns, which can be generated over the long term from within capital markets as a whole. So they really think about that beta piece and the capital market assumptions. And from their perspective, the impact of climate change should permeate quite broadly. But a lot of clients actually went about this in reverse order. So while we started with the top down, sort of reflecting our general bias perhaps, and then moved down to the bottom up, most clients went about this the other way around. So they started with implementation, more of sort of a satellite type of approach, and are now thinking about that top-down asset allocation piece. One piece in addition, which has really resonated, is a physical risk aspect. You and I talked about it a bit, but it's really difficult to do because of the paucity of information there. So thinking about security level analysis, for example, and inputs, it's something we can help clients with because we built the tools that enable us to do that. But understanding physical risk is a really essential part of building resilience to climate change. So while portfolios can go only so far in a way, given where capital markets sit currently, you need to have that extra piece of physical risk, whether that's adaptation, understanding the risk side of it, in order to really take a holistic approach towards resilience in your portfolios.
You mentioned insurers, Supriya, and I speak to a lot of our insurance clients as well. I can attest that they're definitely ahead of the curve in incorporating climate change into their capital market assumptions and how they think about the world. So what have you learned from their feedback?
So you're absolutely right, Thomas, in that insurers are certainly among the most affected. So that's on the liability side for sure, but also think about their assets. And when I speak to my colleague, Tim Antonelli, who's one of the co-authors of the piece, he makes the observation that they're surprisingly still siloed in that there's a disconnect between the climate impact on liabilities and on assets. So they need more consistency across functions. So P&C, so property and casualty insurers, think a lot about climate given their underwriting, but there are other areas like health and life insurers, for example, who are further behind, where the liability modeling doesn't reflect significant changes from climate. So there is sort of a range here. We'd also expect the global demand for regulation on the insurance side to become more friendly to incentivize climate-related investments. So we've seen recently Hong Kong implementing reduced capital charges for green bonds, for example. That's one among many.
All right, so what comes next? I mean, how do you plan to hone this research over time?
Yeah, the possibilities are endless, but we have to focus. So an important part of how we do this is that we need to revisit our scenarios and assumptions at regular intervals as this is an evolving field. So we do this as a team on an annual basis. The other issue is that there are a lot of subjects that we haven't cracked or we haven't delved into in as much detail as we would have liked to have, are the valuations piece and the horizons piece. So in our capital market assumptions, we explore the impact on earnings, for example, or on credit losses, but not on valuations. So we don't have the level of conviction that we need to really build in assumptions on how climate change impacts the valuations of specific assets. In terms of horizons, it's really this question of what is a right horizon. So we use a 10-year horizon for our capital market assumptions, but we know that results can vary over shorter periods. So should you undertake some shorter-term analyses as well, stress tests, for instance? We also know that climate change represents a tragedy of the horizons, not my words. I believe it's Mark Carney's, but it may have been somebody else's as well. And it's this question of whether we're underestimating the long-term cost of inaction. For example, we know there are tipping points in climate science, And how do you think about, as a financial analyst, the right long-term discount rate if the cost of acting late is orders of magnitude higher than that of acting early? So it's really about what is the right horizon. There's no easy answer there. And we also want to use that research practically to help us build better, sustainable multi-asset solutions. So, for example, things that we've really delved into in Pillar 3, how do you align meeting portfolio objectives, be they income or total return, with allocating to sustainable investments? So that's also an area of focus for us.
Yeah, the one thing that I'd add to that is, in my own experience, really steering into the science has been an effective tool in coming up with effective strategies. And that science, as you say, is changing all the time. So I think it's really important to have these close relationships with climate scientists and other experts in the field. But last question. Are you reading any good books that help you see the world more clearly?
That's a good one. And I just make the point that I feel like I'm stretched between a lot of book clubs at the moment, but it's a good way to spend one's time. So in terms of climate specifically, actually, I recently joined our internal book club. It was organized by the Sustainable Investment team. And one book we had to read quite recently was Kim Stanley Robinson's Ministry of the Future. So in some senses, it's an uncomfortably realistic future state of the world where we sort of reach the brink of the precipice. We sort of fall off it momentarily, but in a sense, we pull ourselves back. So it touches on everything from heat domes and geoengineering and even climate quantitative easing as potential solutions. So it's uncomfortably realistic science fiction is how I would put it, but very, very interesting.
Speculative fiction is the way that I characterize Kim Stanley Robinson.
Did you read it yourself, Thomas?
Yes, I would also highly recommend that book. I think he delves into the science properly, but what that book does so well, I think, is incorporates the political and social aspects of climate change, which you don't always get with the science. So it's a really nice blend. Agreed.
And the other one, which I read recently, which is sort of very different. It's incredibly pragmatic and practical and interesting in a very different way, is Hannah Ritchie's book, Not the End of the World. Sort of a view of where we can have the most impact when it comes to environmental challenges. So a very kind of dispassionate view of it in a way, busting some myths along the way, offering solutions, practical ways in which we can make a difference. So those are a couple of books which come to mind, and I'd recommend to listeners.
All right, well, let's end on that relatively positive note. Once again, Supriya Menon, Head of Multi-Asset Strategy, EMEA. Thanks for joining me on Well Said.
Thanks for having me. It was fun.
The Well Said podcast is a Wellington Management production. Our producers are Colin Hopkins, Mark Murphy, and Dana Wickstead. Editorial support from Colin Hopkins and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Animation support from Rasa Sermonte. Production support from Dave Crow. You can listen to Well Said at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.